My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin. LME 3-month nickel. 12 weeks ago I lodged the idea of being a large bump and run reversal pattern stretching from July last year until May this year, in both your own and my mind. This was a transformation from an earlier descending scallop pattern formed over the same period. I asked you to bear this in mind just in case for future use, as it was a pretty large pattern. However, this large pattern has since morphed again back into a descending scallop pattern, especially in recent days. Looking closer at more recent action, we had originally an early February to late March bullish Andrews pitchfork that showed the bullish angle of attack of the market until the middle of May, when the market breached the upper tine and the breach was repaired, but in doing so prices swung around 180 degrees and headed lower, pushing down through the lower tine 11 weeks ago, carrying on down within a steep bear channel to the start of July, when prices hit the June 2021 low at 17,095. I said about this 9 weeks ago, and I quote, "This bear channel will dictate the market for the immediate future until it is broken or until the bear channel morphs into something else." End of quote. 6 weeks ago, the morphs into something else happened, with the market sidling sideways out of the bear channel and in the process forming a potential bearish halfway hesitation that 2 weeks ago became a reality. Now, if we look at the formation of the V-top with a pipe top at its apex formed over May, and the subsequent moves lower, we can see that this whole V-top action from even February to date, it was not just a simple V-top, but a V-top with an extension. In these types of V-tops, after the peak, the market starts moving lower, but then forms a hesitation or congestion of sorts, usually a pennant or a bear flag type pattern on the way lower. This hesitation happened here over late June until early to middle July. Could be regarded, as I said 8 weeks ago, and I quote, a hiccup in the road lower. And with this in mind, another factor to consider is that if we do see prices move down into the 17,000 to 15,845 zone, then the big pattern idea, the one of the descending scallop pattern, morphing into a bump and run reversal pattern with some large upside potentials, well, that pattern idea may be morphing further back into a descending scallop pattern, but with some significant bearish potentials. Watch this space, and that's the end of the long quote. This is where we were 3 weeks ago, moving lower, corralled, unlike other metals, not by a bearish Andrews or shift pitchfork, but by a simple dark blue, it was dark blue, it's not anymore, late May to late July downtrend. This all stopped 3 weeks ago when very significant lows of late November 2023 plus January and February this year in the 15,840 zone were tested, and they cracked the downtrend. They didn't crack, but they cracked the downtrend. In many ways, this was not a surprise, not at all. It is this point that I feel obliged to mention once again the big descending scallop pattern idea and what it may mean within the near-term universe. So the key level, as I've already mentioned, are the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break below that level would give a potential for the descending scallop pattern on the downside down to the 13,830 zone, which is not too far from the potential below for the bearish halfway hesitation. This all came down to what the market would do now that prices had reached the 15,840 zone. Well, the market bounced upwards and over the start of August sustained the bounce, and this week has started to move higher. Last week I drew a July-based bearish shift pitchfork on my daily chart, a small one I grant you, in the hope of possibly seeing a newer, shallower bearish angle of attack. I said at the time that I was not in love with this pitchfork and I would retire it in a heartbeat if appropriate. Well, the heart has beaten many times since and I have retired it completely. What I have seen since then is the possibility that the action over late July to August may be a possible mini cup with handle pattern. If this is the case, then we have a primary target X in the 17,200 area and a secondary harder to reach target X1 up in the 17,470 area. These are doable targets, but prices have to overcome some obstacles. First off, the declining green short medium moving average, currently 16,865, which is being tested today. And then the June 2021 low at 17,095. Then the stiffer, slowly declining gold long moving average, currently 17,350. Beyond these, we have the October 2019 high at 17,815 and the June 2021 high at 18,610. These are in fairly free areas overhead. My only concern is that the ammunition we've accumulated during July and August may not be enough to tackle these this far upwards, but we shall see. LME 3-month zinc. This market peaked this year at the neckline of the September to December 2022 reverse head and shoulders pattern with a horn top in late May. Prices moved back down, rejected by this neckline, reaching the primary and secondary targets for the horn top. But the decline became hesitant in mid-June, especially when it tested the interesting support, currently at 28.12, of the dark blue broken upper tine of the old May to August 2023 bullish shift pitchfork that had acted back then as an August 2023 to April 2024 upper bull channel line. Remember that? It's a bullish shift pitchfork, but it acted as a bull channel. Excuse me. Please remember the broken upper tine and the pitchfork as we become relevant again. Anyway, I said 10 weeks ago, and I quote, "This is the first decent support we have seen, though I would not be surprised if prices do move further down near the middle tine." That's currently at 26.48. That's the end of the quote. However, first prices broke higher late June and peaking in early July, just over the big old 50% Fibonacci line for the 2008-2022 move at 29.65. I said 10 weeks ago about this move higher that, and I quote, "can look as also a possible form of a halfway hesitation in a potentially much larger move lower. We'll have to see how this develops, and I am sure it will have caused a move, or at least cause another change, another morphing into another pattern by then." End of quote. Since then, the market has undergone a number of changes, turning lower and indeed becoming a bearish halfway hesitation pattern, reaching its potential below down in the 26.30 zone 3 weeks ago. Last week, this gave me the opportunity to draw a new late May to early July bearish shift pitchfork, highlighted in bright red on my daily chart. For the moment, even now, this pattern is showing the driving bearish angle of attack of the market, though I have to admit, firstly, this is quite a wide pattern, and secondly, we are close to seeing the upper time being tested, currently at 28.60. You see, in the last 2 weeks, prices have driven higher over the broken dark blue middle tine, currently at 26.48 of the long move, and over the long moving average, currently at 26.70, and today over the combination of the June 2021 low at 28.10, the broken dark blue upper tine, and the slowly declining green short medium moving average, currently at 28.11. Prices have even approached, though not yet tested, the overhead mauve medium moving average, currently at 28.44. Additionally, all this goes against the monthly key reversal down here seen in July, and the shadow of this hovers over all of this market. Hence, whilst I still value the bright red upper tine, it would not surprise me to see the July 2021 low at 29.05, the August 2021 low at 29.17, and even the overhead congestion between 29.58 to 29.65, all these being in the frame for possible testing. You see, we are on today for a possible daily key reversal. Watch to see if prices tonight close over 27.91 or not. Additionally, we might just have a late July to date small reverse head and shoulders pattern, with this potential daily key reversal down today possibly closing over that neckline if it does. And that's the neckline's currently at 28.11, and the market doesn't look like it's willing to do that just yet. But it has all the implications that such a close over it may have. LME 3-month tin. Over April and May, we saw the market form a double top, Adam and Eve type, leading to the creation over April to July of a triple top. It also clarified the April to July sideways triangle, which had a first false break on the top side, but then a proper break lower late 5 weeks ago. I said as much 8 weeks ago, and I quote, "As a result of all this, a new larger pattern emerged last week," so that's now 8 weeks ago. A new larger pattern emerged last week, a late April to date sideways triangle. This pattern is much like the double top, still not complete, having only 2 touches per side, but it has potential, so I could see it working together with the double top idea, or maybe not working with it and making something else. Either way, keep a close eye on the lower uptrend, as it could also be seen as the neckline for the whole double top idea. End of quote. Sorry, it's a bit of a long one. The market followed up with some of these ideas. For the sideways triangle, the market reached down to the primary target, but not the secondary harder to reach target. Likewise for the triple top, prices reached down to the primary target, but not the secondary harder to reach target. On the way down, the congestion between 28,835 to 29,005, containing the July 2011 high at 29,005, plus just below the slowly rising long moving average, currently at 28,920, and the nearby neckline extension of the October 2023 to January 2024 reverse head and shoulders bottom, currently at 27,830, and finally the 50% Fibonacci line of the March 2023 to April 2024 move at 27,330. All these slowed, stopped, and at the start of August turned the market higher. In hindsight, I suppose you could also throw in the dark blue middle time, currently at 27,630 of the April to July bearish Andrews pitchfork as well, but I'd personally stick to the gold long moving average and the congestion zone. Since that push back up in late July, almost looking like a double bottom, prices have risen, gotten stuck in what I can best describe as an accidental congestion area overhead, created by the mauve medium moving average, currently at 32,070, the green short medium moving average, currently at 31,895, the 50% Fibonacci line of the March 2020 to March 2022 move at 31,845, and the neckline of the thin and tall April based head and shoulders pattern. Yes, that one. The one I mentioned a lot back then. That's currently at 31,735. This accidental area is actually the gateway to a whole load of congestion overhead, dating from early April until mid-July. And until last week, I had doubts about whether the market had the ammunition or the inclination to take things higher. And I suggested that, for the moment, watch the dark blue April to July bearish Andrews pitchfork, and for it to be the main guide in this market, especially after we had a monthly key reversal down in July. However, yesterday and today's actions have gotten me questioning that, as prices have risen up to congestion at 32,685, as well as the dark blue upper time, currently at 32,705. And we've not broken over these last two as yet, but I would pay close attention to any confirmed break higher, as beyond we have little in the way until the previous all-time high in April 2011 at 33,610, and the 50% Fibonacci line of the March to October 2022 move at 34,175, the latter being a significant level. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.